What should investors who are investing at home be careful of? I talked to Daniel Lacalle about it. He's been a very successful trader for decades. He's now the chief economist at the Tressis hedge fund.
I think that anybody must be at least careful about the fact that most of the markets that we're looking at, particularly at the index level, are very expensive. And it's always dangerous to jump into a market at all-time highs, particularly with money that is very much needed in the short term. So when we invest, we need to be aware of the fact that losses may and can happen, but more importantly, that what we need to do is to use money that we are not going to need for something urgent quickly, because then our decisions are going to be negatively affected by the pressure of having to use that money short term. So I think that any retail investor must be aware of the fact that stocks in general are extremely expensive, and that the latest round of stimulus packages that have been announced both by the Fed, by the US government, and by the European Central Bank, all of them come with diminishing returns. So I think that just be prudent, like you would do with your own saved money.
And is it possible for an amateur, for somebody who's quite new at this, to actually hedge the risk in this type of a market?
It is possible. It's very difficult, I have to say. In general, I think that a retail investor should be, unless that the person is on top of markets all day and looking at screens and has an experience in day trading or in technical analysis, etc., an investor should be prudent, long-term, and conservative. And I think that prudent is one thing, because it means that you're basically understanding how you're using that money. Long term doesn't mean buying anything and hoping for the best, but buying stocks or bonds in which the fundamentals are strong for a prolonged period of time. And conservative in the sense that the worst thing that retail investors can do is to jump into the more cyclical, the more aggressive, the higher beta type of stocks or assets, because usually, as we are seeing, for example, right now with so many technology or electric vehicle stocks, is that retail investors come probably at the moment in which most of the good news have been significantly discounted.
And this type of knowledge that you're talking about, is this something people can pick up from YouTube videos, or where can you find this type of knowledge and experience?
Well, obviously, unfortunately, experience in markets is gained through losses and through mistakes, like almost in anything, you know? And I think that one of the problems of many of these courses that you find online, etc., is that they present an almost idyllic world in which you're going to see no losses and you're going to make a lot of money and you will retire in 1 year. No, I think that basically what you basically learn from experience, and it takes years. So, you know, it's better to go to professionals, and it's better to go to professionals understanding your real appetite for risk. One of the things that maybe we get a lot of times from people is that they have a much lower appetite for risk than the type of returns that they want to achieve. For example, if they want to achieve returns of 6, 7, 8%, when the lowest risk asset, the 10-year government bond, is yielding negative real returns, obviously they're going to have to take a lot of risk in order to achieve those returns. So sometimes we have a false perception of our risk appetite. And I think that what's important always is to be a bit more conservative than what you think your profile is. And that tends to help you do two things. One is to preserve capital, which is the first thing that you need to do in an environment of financial repression, to keep the money that you have saved. And the second is to achieve sustained and consistent returns, and that is difficult. Therefore, if you steer away from the more cyclical part of the financial asset market, and you stay away from the more aggressive things that come always in the headlines, X and X asset reaches all-time highs. Well, obviously, if you're reading that, by then the vast majority of the positive information is already discounted. So what you basically have to be almost like a surfer. You can't be, at in the area where there are no waves, because then you're bored, and you cannot be at the peak of the wave, because then you're going to crash. It's complicated, but I think you basically learn from experience.
Nice analogy. Daniel, really appreciate it as always. Thank you so much.
Thank you so much. Have a good day.